Right now, we've been talking all day about recreational boating. I know Paul referenced it. I referenced it in my opening comments about the explosion in the recreational boating industry. And to tell us a little bit about that is Ed Bragg of Wells Fargo and Company. Ed leads DF's Marine OEM team in the United States, the general manager of DF's joint venture Brunswick Acceptance Corporation, responsible for OEM programs and relationships, as well as leading DF Marine's development of market insights and analytics. Ladies and gentlemen, please welcome Ed Bragg.
Well, good morning, everybody. I want to thank Eva, Paul, and the team for having me here. I was last year speaking to you a couple of years ago, June of 2021, I believe. Who was in the room at that time? Raise your hands. So for those of you that weren't in the room, so this presentation is going to be a little different because last time we were kind of skiing downhill, right in the wave of all this pent-up demand, the first-time boat buyer wave, all this excess cash that just flooded the U.S. economy that found its way into our industry. And at the same time, really struggling with supply chains to get inventories out the door to meet that demand. So we had a bunch of scarcity. So right now, quite a bit different economically and in the boating market, we are in a time of transition, and I'll call it transition to normalization. And so I've got about 15 slides or so to go over in the next half hour. I will be quick and brief on most of them. I'll be available for questions afterwards if you have them. The presentation that we have today, I'll make it available to Eva to send out to you. If you just ping them and they can send you a copy, or you can get with me directly. The contact information is on the back of your agenda pamphlet. So what I'm going to talk to you about today is, again, this time of transition into normalization for the recreational boat market. It is definitely a multi-speed market, so not every market is moving at the same speed or landing at the same place, but it is also hot and cold. So one week's great, the next week's not. You may see that in your own business. And there's a question out there whether we're going to normalize to a pre-COVID average or we're going to normalize to a pre-COVID average minus a couple. And so that's up for debate at this point. But what I'm going to talk about today, Wells Fargo's expertise in this is we do new boat dealer floor plan. And so we finance roughly half the industry's boat production in North America. We do it also in Europe and Australia, New Zealand, some in Latin America. So we have kind of a big portfolio of information. And we turn that around, and you'll see that in the data. We turn that around for our constituents and our customers to benefit them in helping to navigate their own dealerships and their own segments they participate in. But again, I want to reference it's new boat inventory that we're talking about. So let's go to the first slide. I got a few pages on economics. And I want to thank Sydney Coulter for staying up late last night and updating my presentation, because Wells Fargo just dropped the bomb on us yesterday when they changed their outlook for this recession that everybody's talking about, right? It's the most talked about recession in my lifetime. It isn't here yet. And what Wells Fargo did, if you look at the top right of your screen, you'll see GDP over there. And you'll notice there's nothing with a minus sign over there for 2023. It's an annual average of roughly 1.6% for this year. Wells Fargo previously and long has been of the belief we were going to have a recession in the third and the fourth quarter of this year. But yesterday they changed their opinion, and the opinion was changed based on two things. The labor market is too strong. And consumer spending is too strong for it to occur in the back half. So they punted and moved it out into the first and second quarter of next year. But they made it shorter in duration, so just 2 quarters instead of 3 quarters. And they made it half as weak as they had before. So they were calling for like a 1.3, 1.4 decline in GDP for the second half of this year into the first quarter. And they moved that timing-wise, to the first quarter and the second quarter of next year, and at basically a minus 0.7. So they cut it in half. So it's going to be shorter and more shallow than previous. And again, the driver for that is in the bottom right side. So you may have heard, the Federal Reserve, wants to build the case for a soft landing. Soft landing means we can get inflation down without killing the economy. Well, the case for a soft landing in a recessionary environment is when you have the labor market with unemployment numbers that are under 5%. So normally in a recession, unemployment's, close to double digits or high single digits. But we've got basically full employment, and that's driven by demographics. We just don't have enough people to supply the 10 million job openings that are out there right now. And those ticked up again. So it's the consumer is stronger because they're more employed, and the labor market is stronger than the Fed wants it to be. And the Fed is responding, with interest rate increases. So if you look at the Fed funds rate, Wells Fargo's forecast went up from 5.25 rate peak, which is where we're at today, to a 5.50. And we've got another Fed meeting here in June. And Wells Fargo and multiple other banks think that the Fed's going to take a pause on that and not do any rate increase, but there's another 25 basis points embedded in Wells Fargo's forecast. And then they think we sit there until this time next year. And at that point, we've got a full 2.5% worth of rate cuts coming next year as we're into this recessionary outlook. So some good, some bad. The good news is the consumer's stronger, the labor market's holding up better, but that's not what the Fed wants. The Fed needs the labor market to cool off so they can get inflation down, so they can bring the rates down. So it's kind of a double-edged sword there. Well, looking a little bit more into the consumer spending. So I talked about, 2 years ago when I was here, we were all shocked about the amount of wealth that was out there, the amount of cash that was coming in and buying our boats. And the reason for that, other than the Treasury inflating our dollars and throwing $9 trillion worth of stimulus into us, consumers capture that money in their bank accounts. So there's two ways to look at this. On the left side, that kind of blue line, that's the excess accumulated savings that households accumulated during COVID and how much they have left today. So it peaked at about 2.2 trillion over the normal run rate, and now it's down to about $600 billion. So the good news is it's still left, and maybe the better news is it's mostly in, the demographic profile of boat buying clients. So the more affluent people have all this money. And it's our job to make sure they depart from it quickly. The right side of this page shows, basically the same thing, but instead of just the excess, it shows the total amount of money people have in their bank accounts. So something just under $14 trillion right now. You can see on the right side, it's also upticked. And Wells Fargo's expectations are, no matter what side of the screen you're looking at, it's about 6 months left before it's back to normal. So we've got a window of opportunity here to help our moneyed clients depart from their money, before it gets back to normal. Another way to look at this is to find out, why this consumer spending is staying up nationally. And, the focus here is really on the purple line, the excess personal savings. You can see that's diminishing, which is what we just saw on the last page. But what's taking over is kind of the light blue bars there, which represent disposable personal income. So again, consumer spending patterns are normalizing from something they've accumulated in excess over a period of time through fiscal stimulus or forced thrift. They couldn't go to Disney World. And now they're relying more on their incomes to support their spending growth. So again, that's normalizing as well. And let's look at their confidence. So consumer confidence is kind of an interesting thing. I don't really care in this industry how confident the overall consumer is. I care about how confident the boat buying consumer is, and they're a very different demographic. And they typically are more confident than the overall consumer. But On the right side of the consumer confidence index on the left graph there, you will see kind of a downward tick in confidence of the overall American consumer, but the expectations were really for a much bigger dip than what has actually happened. So consumers' confidence, in spite of all the negative headlines that we get every day, is continuing to hold up fairly well. And when you look at the buying patterns, or the expectations to buy they have for three different types of goods. They've got the automobiles on the right side, the dark blue line. You've got the major appliances and kind of the lighter blue line. And then you've got homes on the orange line. They are all kind of declining in terms of people's plans to buy, but they are all way up versus where they were pre-COVID. So there's still a lot of interest there. And, interestingly enough, all three of these sectors were also suffering from price inflation. So houses are way up, appliances, everything's way up. So just like boats, the price of things costs a lot more, but people's interest in them is still continuing. So I'm going to move on from some economic slides to some of our portfolio recreational marine new boat information in real time. So these two charts represent retail and wholesale in the industry for new boats. And on the left side is the retail page. And it shows week over week change versus prior year in floor plan payoffs. And what you see happening here is the month of May, which is the far right of the left graph there. You've got fits and starts. 1 week floor plan payoffs are down, the next week they're up. We generally saw a really nice Q1 that basically normalized to a pre-COVID average. Things seasonalized as well. Normalization showed up in the seasonal patterns of our boat buyers. So that changed as well. And we were quite happy with where things were for the first quarter. April was a big disappointment. Weakest April that we can remember on record. And the first several weeks of May was also bad, but the end of May, right around Memorial Day, was the biggest floor plan payoff week we've had since 2020. It was a record, and that trend continues into this week as well. So things are heating up a little bit. April can be explained away by a lot of weather patterns. I don't know that I would jump on anything more than that at this point, because everything that was in the economic headlines, in April was also there in the first quarter. Nothing really changed materially there. And weather, with the exception of Florida, was generally pretty bad across the entire country. On the shipment side of things, factories have reloaded all the dealers with new boat inventory. And with the weak April and the first 3 weeks of May on floor plan payoffs, we've probably got a little too much inventory right now at the model year change. And so you can see the cadence of manufacturer shipment growth has been going down. For the month of May, it was a -5. We think it's going to be down -10 in June. And we think it's embedded for, -20 to 25% for the second half of the year, unless retail picks up. And looking at the inventories, so the way that the industry measures the health of the fleet is by weeks on hand. So each of these numbers on the graph on the table there represent a number of weeks of inventory in the field for all new boat types. And again, I mentioned at the beginning, it's a multi-speed market. So not every segment is moving at the same pace, but this is the average for the entire fleet. And when you look at Q1 of 23, the bottom left number, 32 weeks, we got fully inventoried back in this industry at the end of March. And since that time, we've had some weak retail, and the wholesale continued to moderate, yet grow a little bit. And we're ending up with a little bit too much inventory in the field. Right now, we've got 3 weeks too much. Depending where June shows up, it might be a little more. Who knows? But we've got 50% of our retail year. Hey, thanks, brother.
Like you needed a buoy.
Thank you. We've got 50% of our retail year left. So the focus for all the dealers in the industry is to move this retail out the door so that they can get fresh product that are better margins, for next spring at this time. But absent any of that, like I mentioned, we have embedded in our forecast a 20 to 25% drop in new boat inventory. So you can expect that retail is going to be very aggressive for the next 90 days while the season is still going. So the multi-speed market side of things, we've got 5 segments we're tracking here, and you can see the differences in the weeks on hand. The saltfish segment, which you care about, the yacht segment, which you care about, are still way under inventoried. Yachts have been struggling on the new boat side because of supply chains. It's much more difficult to procure 10,000 parts than it is 200 parts for a production boat. So the supplies are still very short. And the numbers to the right of that, January through May, those are all the growth rates or the contraction in floor plan payoffs, or otherwise known as retail. And you can see the strength at the floor plan payoffs that we see month over month in the yacht industry, as well as the saltfish industry, compared to the total. So looking at the total, this is retail registrations for the industry, our estimates through May. The bottom part of the bars is the first quarter, and you'll see I've got a circle around 2016. So this is where first quarter ended up in the US for new boats, roughly around 2016 and close to 2019 numbers. So pretty much the average. It actually outperformed our expectations. We thought with all the headline economics, it would be a little softer than that. So we were very happy with that number. But then April and May came, and it moved to like a 2013 cadence. And that's 10 years ago. That's a long time ago. And so the question in the room for everybody is, which market are we in? Are we in the April and May market? Are we in the 2016 market? Because there's a material difference, at the end of the year on the growth rate or the contraction of new boat retail. Looking at new boat retail, I'll go through this really quickly because it's only through April and it's a -16. And don't get too hung up about that because it's all about the normalization of seasonality in our industry. A year ago at this time, we were selling a lot more boats in the off season because we could, because of shortages. And so we had inflated numbers, from the periods of November through March at retail, when buyers up north typically don't buy. That's really where most of the -16 is coming from, is really difficult comps. But I want you to pay attention to that -13.75 for 2022, because some context is really important in understanding why this is. So why did we, when things were still going pretty good in 22, go down 13-14%? Well, the first half of the year, the primary part of the selling season, we didn't have any inventory. We didn't have enough. The second thing is seasonality. The second half of the year normalized. So consumer buying patterns, they no longer bought in the off season. They went back to their old behavior. And so our retail softened against a tough comp, and it went down there. But the third reason, and this is something I spoke to you 2 years ago, was the first-time boat buyer phenomenon. 41% of the reason that we were down 13.75% last year was that first-time boat buyers completely normalized. So the gray bars on this graph represent the number of first-time boat buyer households that buy a new boat. And pre-COVID, it was roughly 45,000. It ticked up to a maximum of about 70,000 during the height of our wave during COVID, but it's went back down in 2022 to 45,000 people. So that is the reason that most of the decline for 13.75 happened. So it's important to understand kind of the context. It's really not quite as bad as it was. Which brings me to our forecast outlook for the recreational boat market for these 5 segments for 2023. And on the right side of the page, you'll see forecast version 1, forecast version 2, and some comments. And forecast version 1, if you refer back to my other page and I asked the question, where are we? Are we at 2016 retail or are we at 2013 retail? Well, if we're at 2016 retail, then -1's your number for the total year. And I think everybody in the room might sign up for that number. And I'm leaning more to that number because of what I've seen recently in the recent weeks with this pent-up demand this pent-up retail beginning to pull through in our own floor plan data. The -6 is kind of the middle point. Really, the goalpost on this thing is kind of a -10 to a -1 on where we're going to go. But one thing that is a little different in this is on the saltfish side. Really, we see upside. We see a potential for positive numbers for the saltfish segment. We don't forecast the yacht segment because there are just not enough units that go through to build an algorithm that makes the model work. The rest of these, have tens of thousands of boats that are going through and allow our data scientists to do their modeling. But we've got 50% of our retail year left, from June to December, to make hay happen and capture that $600 billion of excess cash that our consumers have and bring down some of the field inventories to a more balanced level so that we can have a soft landing and the right mix of product in the field so that our dealer customers aren't cannibalizing, margins against each other, trying to unload a bunch of product. And so that's what we're trying to help the industry shepherd into. Looking at the health of the fleet, I'll focus on the bottom right on this screen. This is birthday boats. So boats that are over a year. And the numbers on this graph are really for the past 3 years. So really the past 3 years, we've hardly had any old boats. Right now, we've only got 4% of the entire fleet that has had a birthday. A lot of that is dealer demos or pro fish and pro wake, guys who keep them for multiple seasons. So we really don't have any old boats in the fleet. But this is going to go up. It's going to normalize. And normal looks like 10, 11, 12% of the fleet. And the RV industry right now, they went through this transition to normalization a year before us. They have about 18% of their fleet old. And if you talk to the dealers, you'll hear a lot of dealers say they've got 25% of their inventories 22 model year and older. And that's just astounding. But the RV industry went through this transition, and instead of being promotional at retail and trying to correct the imbalance between wholesale and retail in the field, they did it just on the supply side. They cut production by 55%. They went from 600,000 units in shipments to 285. And they tried to cut it that way. So what that left the dealers with was nothing but old boats or old RVs, to sell. So they're in a bad position right now. And that's why our focus and our message to the market is it's got to be done. The factory's got to do their job, and they're already doing it. They're already pulling down production. But we got to retail our way out of this thing as well. Looking at a couple slides on the health of saltwater fish boats by different lengths. The top line there is 30-foot plus saltwater fish boats. It's the number of days in inventory. It's from our third-party provider, InfoLink. And you can see 30-foot fish boats are starting to grow their days in inventory again. So they are kind of normal. Smaller fish boats, are not quite as in favor, but a lot of the OEMs de-emphasize producing those. So there's, kind of an imbalance between what the real retail demand is and what the inventory levels are. But the yacht side of things, still all-time low field inventories. we've got hardly any yachts. We used to carry a portfolio of $250 million in new yachts on our floor plan. I think we've got maybe $40 million left today because it's spinning so fast. The backlogs are so long. The customer sold backlogs are very long. The factories are still struggling with supply chain issues to get them out. And, it's leaving field inventory, fairly depleted. But kind of the word at the Palm Beach show, was that some of the backlogs are starting to shrink a bit. So we should see over time, normalization in the yacht market. It's just probably a year or so out for doing it because of the length of the backlogs that are in the channel. So it's going to be an inventory-starved new boat industry for the yacht segment for quite some time now. But that is pretty much a wrap on what I had to say. So we've got an economy in transition. We've got some good stuff going on with the consumer. And it's softening this, long talked about recession that we're going to have. It's kicking it down the road a little bit. It's making it shorter than it otherwise would be. And we've got normalization, kind of running at full speed where we're landing, somewhere in this 2013 to 2016 range of product. And that's all I had to say today. If you have any questions, Paul's got a mic, and I'd be happy to answer anybody's questions.
Gotta be in the back of the room. Okay. That's all right. Wait on me. I gotta get in my steps.
No questions from him.
Yeah, he's suspect.
Yeah, I'm Howard McLennan, Wells Fargo Private Wealth Group. Thank you for your presentation, Ed. So in 1984, the Fed raised rates 18 times in a row. I was on a trading desk back then. Kind of take your Wells hat off, and what do you think the normalization of interest rates, if they're going down 2.5% next year potentially, is going to do to the people in this room? What do you think they should be prepared for? Is that going to improve things a good bit, or what are your thoughts there?
It's going to bring down borrowing rates for the consumers. So the consumers will see some relief on what they're borrowing. I don't think those consumer rates for boat loans are typically tied to 10-year treasuries. I don't think the 10-year treasuries are falling quite as fast as the overall Fed funds rate, but it should downtick to the extent that the rate and the level of rates today are a barrier to closing a deal for you. There will be relief in the future. And Howard's got plenty of data to give you on that.
Ed, do you think that April downturn had anything to do with the bank failures and the collective public just taking a little gasp and a little pause?
We heard people talking about that. It's impossible to quantify. I do think it was mostly weather. But they're, like I said, when the weather heated up, our floor plan payoffs went to a record level since 2020. And those 2020 numbers were astronomical. That's when we had the great run on boats. And we haven't seen numbers like that since then. So I still think there's retail demand out there to be had. There are buyers that want a reason to do a deal. They have the wherewithal to do a deal. The OEMs and the dealers need to be promotional and aggressive at making it go away.
Any other questions from the audience? Good opportunity. Oh, hang on.
James Faulkner with JFA Yacht and Ship. Thanks for being here. The question I have is, what are some of the threats that you see to your forecast coming into 2023, 2024?
The economic forecast of the boat industry?
Both.
Both. The threat.
Can I answer that, Ed?
Yeah.
Stay tuned, because at 4:00 we have a economic futurist that's going to talk about geopolitical enforce.
He will be much more capable of answering that question. But the real threats are, I asked the question, what market are we in? 2013 market or 2016 market? And, I meant that as a serious question. It's really up to you to figure out what market you want to be in, because what you believe is what you get, probably. So I think the real threat to this is we don't step on retail right now. We continue at this April and May cadence, and we end up with a very bloated field inventory that's going to cause collateral damage next year to dealers' cash flow. It will create a margin frenzy, for consumers that will be opportunistic at that eventuality. So that's my biggest fear for our industry. What's going on is we don't solve the problem now while we have the opportunity, and we kick the can down the road, and it's going to be a bigger issue.
Bob, your baby. Oh, I'm sorry. I should look at the front, huh?
How would you respond to a client saying that they expect brokerage boats prices to go down in the next few years? Like, is that true? Is that accurate?
And the production, my expertise is on the production boat side of things, but there's no manufacturer that has a viewpoint to lower prices versus what was just sold into the channel. They're not going to threaten the rest of the fleet, by lowering prices, even if they could, because it's just not the way you work it out. What you do is you can keep things flat, or you can give some extra rebates on the back end, but the base price of the boat isn't going down in the industry. It's going to stay. They'll work their way out of it over time by keeping it flat or offering some incentives to dealers.
Typically, over the years, we've seen that increase in retail prices buoy up the values in brokerage prices, but increased market pressure puts more pressure on brokerage boats, which tends to drive prices down.
Yeah.
So when you've got more choices, when you've got 6 61 Vikings available versus 2 61 Vikings available, or 1 61 Viking available, there's price pressure on those 6 that doesn't exist when there's only one out there. But the new boat prices, in the old days of 53 Hatterses, as they drove up in price, the value of the used ones were driven up. So brokerage is a very different market than new.
Yep. All right. Well, thank you, everybody.
Thank you very much, Ed.